All right, let's take a look at the market technicals. Joining us now, Katie Stockton, Fairlead Strategies founder and managing partner, and a CNBC contributor. Katie, great to have you here. Thank you for coming in.
Good to be here.
Monday was interesting. Kind of a pretty good shudder in the NASDAQ, obviously led down by NVIDIA. Did it mean anything? Was it consequential in terms of the trend?
I think it was, in a way. So we've been calling this an ABC corrective wave. You know, Elliott wave analysis. It's not really our thing. But indeed, corrections tend to unfold in three waves, right? You get the first wave, that's your A wave, and we had that starting in December. So we were thinking that the rebound, which was really pretty explosive, was the B wave. And they are often explosive. It's counterintuitive in that when you see those big, sharp relief rallies, they're actually more likely to be counter-trend. It just has to do with market sentiment. And then, of course, the abrupt gap down basically took us out of that B wave. So we think that we've initiated a C wave to this corrective phase now.
Now, we're seeing, obviously, day to day, you're going to have today, you have the futures indicated higher on the NASDAQ, you have the earnings reactions. What are we looking for in terms of ultimately what has to be accomplished with this correction? And does it exist within a longer term uptrend, or is this maybe
for sure? I mean, it's a secular bull market indeed, but we do think that this year will be more of a cyclical trading range, something to ultimately refresh that bull market cycle, and that's based on some things that we're seeing on a long-term chart. S&P 500 has sell signals from the DeMark indicators for one, and that would have implications for about 8 to 9 months of just choppy trading. Doesn't need to be a bear market cycle to get the sentiment back in check. But indeed, I think that the AI news, the AI has been the driver of the market, really, and it showed how important that is to the market. So we feel that the sentiment needs to get to a place where it's a bit more bearish, frankly, and that's what a correction does.
The broad market obviously has kind of lost the very clear, strong leadership of semiconductors and broader technology coming into this year, really, back half of last year. Everybody seems to want a more inclusive market. The broadening has become a cliche. Is it happening, and is that a positive thing in terms of, in other words, are we going to get absolute gains from other stocks, or is it just going to be a relative story?
You know, the breadth actually wasn't that bad last year. We had decent participation, but it was really the leadership that was very narrow, and we have lost that leadership in a way, right? Especially Microsoft, Apple. You've seen those corrective phases become really very pronounced, and Microsoft just can't get away from its 200-day moving average, which is now rolling over. So I do think that's meaningful, and I do see some rotation starting to unfold into those more defensive areas of the market. We use something called a relative rotation graph, and it shows that the defensives are probably among the best positioned sectors in a relative performance-wise for the next 6 months or so, which is sort of surprising. It's hard to make a strong case when you look at the downtrend and consumer staples for one versus the S&P 500, but there's a loss of downside momentum there that's meaningful.
What about the 10-year? And the yield there? What are the technicals telling you about a potential consolidation phase? We've seen so much volatility, and obviously that has interplay with the equity markets as well.
We believe yields will work higher, but probably in less dramatic fashion than they have done recently. And they've broken out from a downtrend channel and now are consolidating. I think we're looking for more consolidation to refresh this uptrend, which of course was really quite steep. But that breakout from the downtrend channel also saw a breakout in the dollar index. So we are looking for follow through.
So you think 4.7 at that?
4.7 is a resistance level. And then secondarily, it's 5 to 5.25. We wouldn't rule out 5 to 5.25 this year.